This is OG John AG. What we're witnessing is a massive reversal in precious metals. Gold has surged 11% from its recent low and is now firmly back above $4,900, currently hovering near $4,950 plus. In just 30 hours, it added roughly $3 trillion in market value. Silver has climbed nearly 20% from its bottom, reclaiming levels above $85, now around 85 plus, injecting about $800 billion in the same window. That's close to $4 trillion in total market cap recovered in under 2 days, representing around 35% of the $11 trillion wipeout we saw recently. The real kicker? This explosive recovery happened while retail investors were panic selling at the lows. This is textbook forced liquidation driving prices down, followed by a ferocious short squeeze pushing them higher. Volatility isn't the enemy here, it's the opportunity. After a brutal shakeout from all-time highs, gold is back over $4,900 and silver above 85. Precious metals just regained over $4 trillion in market capitalization. For context, check my recent post on X. A few hours ago, I shared details about the backlash this channel and our viewers faced after I released a video exposing JP Morgan's alleged plans for a market crash. Once you read that post and watch the video, you'll see I was among the first to break this story. Since then, we've seen repeated unsubscribes from our audience, while copycat channels mimicking our titles, thumbnails, and analysis have surged in growth. Whenever we drop a video, imitators quickly replicate our content within hours. They know OG John AG is the original source. Without our research and insights, many of those channels would disappear. But Team OG stays committed, delivering unbiased, well-researched, straight-to-the-point analysis at the top. We're extremely bullish on precious metals, but we're not blind to institutional manipulation or the system's efforts to hide cracks. If you're looking for pure hype, go watch those repackaged copycats. This channel was built on education and unfiltered truth. We won't back down, no matter the pushback. Important reminder, our team has never and will never ask for money. Anyone claiming otherwise is a scammer. Report and avoid them. Our official handles are OG John AG on YouTube and X. We have zero affiliation with the copycats or their hype-driven content. We're currently investigating the fallout from the JP Morgan video and will update you soon. What makes this $4 trillion reversal even more powerful? Another 2.8% of silver has been pulled from vaults in just 1 day. Vault drains are accelerating. Meanwhile, China has revealed its endgame. An article by President Xi Jinping, published in Qiushi, the official party journal, and featured on the central government's website, outlines building a financial powerhouse with a strong, credible currency as the top priority. In the Chinese version, one of the 6 core tasks is achieving a powerful currency. The prerequisite? Gaining pricing power over gold, becoming the world's #1 producer, consumer, and importer, and holding the largest gold reserves. This ties directly to internationalizing the RMB yuan, backed by massive gold holdings. Published around key dates like the September 3rd military parade context in the financial realm, it signals China is nearing completion of preparations. The global final battle for gold dominance is approaching. Gold will define national currency values and the new international monetary order. China is positioning as a major player. This isn't speculation. It's official government policy from Xi Jinping himself. Gold pricing power. Strong currency. Pricing power in precious metals is shifting eastward. Whoever controls and processes the most silver gains leverage. Whoever holds the most gold has the final say. Data backs this up. China is quietly accumulating far more gold than reported. Estimates show November purchases around 10 tons, 11x the official 0.9 tons, following September's 15 tons, 10x reported. Real reserves are likely much larger. Current prices, as recorded, Western spot gold 4,950 plus, silver 85 plus. Shanghai spot and futures show premiums, recently compressed after a 40% crash and 20% bounce, but still elevated at around 20%, 16 plus premium. Physical metal continues trading above paper prices, tying it back. This week's drop was manufactured by big players. While the crowd panic sold, hedge funds and central banks accumulated the dip via algorithmic buying. Paper prices, derivatives, are leveraged speculation, often disconnected from physical reality. The screen price is fake. The real price is set by physical demand. Stay sharp, stay informed. Team OG has your back. This version keeps the passionate, motivational style, but trims repetition, improves grammar, flow, and makes it more engaging for listeners, viewers. Let me know if you'd like adjustments. Shorter, longer, more formal, etc. What you're seeing right now is the true cost of getting metal in your hand. In Singapore, retail investors are queuing up at United Overseas Bank, the only bank offering physical gold, even as bullion prices fell sharply. They're buying the dip, convinced the long-term drivers remain intact. That kind of demand doesn't disappear during corrections. It shows extraordinary retail conviction in physical gold. Meanwhile, gold has recovered $500, or about 9% from the low, and is back above $4,900. Silver is up even more aggressively. Paper markets went absolutely wild. The silver-backed ETF SLV recorded a record $41 billion in trading volume on Friday, higher than any single stock traded globally that day. That's not retail, that's institutional firepower. All the banks managed to achieve by slamming silver lower yesterday was to shave roughly 6,000 contracts off CME Silver Futures open interest. It now sits around 142,000 contracts, well below the 250,000 plus we saw at the 2011 peak. Data makes it clear this is not a retail-driven move. Retail panic sold at the bottom. Institutions bought. The $4 trillion market cap recovery in just 30 hours proves it. Moves that size come from sovereign funds, central banks, not Reddit or small investors. There's a real war underway to secure scarce silver, especially between the US and China. The US government just announced a $12 billion critical mineral stockpile program, $10 billion from the Export-Import Bank plus $1.67 billion in private capital to counter China's dominance in strategic metals. They're telling you outright, secure real assets before currencies devalue. Physical reality is tightening fast. Bullion Star in Singapore has only one 1,000-ounce silver bar left in pre-sale. After that, they'll be sold out of the bars industrial buyers want most. Vaults drained another 2.8% in a single day. Dealers are running dry. The shortage is real. Yet the paper market tried everything, margin hikes, aggressive selling, to kill the move. It failed. Metals keep ripping higher. The banks are trapped in their shorts. The squeeze is underway, and most people still have no idea what's coming. Now let's address the risks, because they are real. Japan's 30-year bond yield just hit its highest level ever. Japan has the worst debt crisis of any major nation, 250% debt to GDP. They hold $1.22 trillion in U.S. treasuries, the largest foreign holder. For decades, Japanese investors borrowed at near zero rates in yen, bought higher-yielding U.S. treasuries, and pocketed the spread. That carry trade is now dead. Japanese bonds yield 3.7%. The spread with the U.S. has collapsed. Why take currency risk for 0.3% extra? They won't. Hundreds of billions, potentially the full $1.22 trillion over time, could flow out of U.S. treasuries. When demand drops and supply stays high, yields spike. Yields spike, risk assets fall. The S&P already shed 2% in a day. Treasury Secretary is calling Japan, begging for calm. The Fed is intervening to support the yen. The dollar was dumped last week at the fastest pace in at least 2 years. This is systemic stress, the reason metals got hit hard initially through forced liquidation and margin calls. But once that forced selling stops, the underlying bid returns. Central banks keep buying. China keeps accumulating. Physical metal stays scarce. That's why we saw $4 trillion recovered in 30 hours. The bullish case remains strong. Stock market concentration is at historic extremes. When this bubble breaks, capital will flow into real assets. Gold, silver, critical commodities. Metals are outperforming and signaling deep trouble in financial markets. Momentum is shifting eastward. China's official strategy, Xi Jinping's article, puts gold pricing power as the #1 task for building a strong currency and financial power. China is buying 10x more gold than reported, e.g., 10 tons actual versus 0.9 tons official in November. Vaults draining, Singapore queuing, dealers selling out, SLV record volume, $4 trillion bounce. The physical bid never left. Only paper got flushed. What could be the trigger? If China is nearing completion of its preparations, as hinted in Xi's article tied to key financial military dates, an official reveal of much larger gold reserves, potentially 10 to 20x current reported figures, could instantly reprice the entire gold market. Every central bank would scramble to buy. The final battle for pricing power would begin. Bottom line, where we stand, $4 trillion recovered in 30 hours, gold plus 11%, silver plus 20% from lows. Friday was forced liquidation. This week is short squeeze. Retail sold, institutions bought. China's official gold strategy, pricing power, talk strong currency, secret accumulation at scale, precious metals pricing shifting east, macro stress, Japan carry trade unwind, spiking treasury yields, dollar dumping, real risks of more liquidation. Physical reality, 2.8% vault drain in 1 day, dealers down to 1 bar, Singapore queues, China buying quietly. March delivery month is approaching. COMEX registered stocks are depleted. Physical tightness is building. The paper market creates volatility. The physical market creates the floor. Do your own due diligence. Understand both the risks, Japan debt crisis, treasury stress, and the drivers, China strategy, vault drains, institutional buying. Decide whether you're playing short-term volatility or long-term fundamentals. Invest with logic, not hype. Use your own brain.